Hi, I'm Mary Dittman with Francis Marion University, and in this video, we'll be looking at how the Federal Reserve uses interest rates to stimulate the economy. The Federal Reserve, or the Fed, was created in 1913, and it is responsible for regulating the banking system in the United States and managing the cycles that the economy will go through. Well, what is an economy? An economy is the system by which a society allocates its resources. Every society has certain resources. These are inputs, and we call them the factors of production. These are things like natural resources, like land, human resources, like labor, people, financial resources. And we take all of these resources or inputs and we transform them into an output. The output that we produce in the United States is called gross domestic product. GDP is the value of all of the goods and the services that are produced in the country. We want GDP to be high, and the reason is, in the United States, we are a market-driven economy. That means that buyers tell sellers what we want to purchase. Manufacturers don't produce cars so that they will sit in a warehouse somewhere. Manufacturers produce cars because they anticipate that we're going to purchase those cars. So in a market economy like the United States, when consumers want to purchase, suppliers will produce goods and services for us to buy, and it is that production of goods and services which is GDP. But they're not going to produce goods and services that will not be consumed. The economy will go through a cycle, and we call that the business cycle. And basically, we're tracking the ups and downs of GDP. When GDP is high, that's a peak. When GDP starts to fall, that's known as a contraction. At its lowest point, it's a trough. And eventually, when GDP starts to rise again, that's called a recovery, which leads us into a time of prosperity and hopefully another peak. When gross domestic product falls for 2 consecutive quarters, a quarter is a 3-month period. So when GDP falls for 6 months, that is the technical definition of a recession. If an economy remains in that sustained downturn for a period of time, the economy will be in a depression. Now, we haven't had a depression in the United States since the 1930s. And of course, as we mentioned, recovery is when GDP is on the rise again. The Federal Reserve wants to smooth out the ups and downs of the business cycle. So when the economy begins to contract, when GDP is declining, the Federal Reserve basically wants to press the gas pedal and get us out of that contraction and back on the road to a recovery as soon as possible. The Fed actually has several ways that they can do this. One way is to lower interest rates. At a lower interest rate, borrowing becomes more attractive. You don't go to the bank and borrow $20,000 so that you can save it in your savings account. You go to the bank and borrow $20,000 because you want to buy a car. 70% of the U.S. economy is consumer driven. That means non-government spending. So 70% of our economy is based on individuals and businesses purchasing. Again, remember, in a market economy, even though GDP is what we're producing, manufacturers won't produce anything if they can't sell it. So consumers have to be willing and able to purchase in order to see the production in the first place. That is why the Federal Reserve will lower interest rates. If we go borrow money, We borrow money in order to buy things. When we say we want to buy these new cars, the manufacturers will start producing cars. That puts people to work, that lowers your unemployment, people are paying taxes, GDP is on the rise because we're producing goods and services. So when we lower interest rates, that should increase GDP, because when we have money in our hands as consumers, we want to expand our business, build a new factory, buy a car, perhaps invest in an education. Manufacturers will produce those goods and services because we have borrowed money to consume them. And that increase in production is GDP. So when we are starting to contract, if people start buying a lot, that puts us into a recovery. We just saw how the Federal Reserve uses interest rates to stimulate the economy. Sometimes the Fed actually wants to slow down the economy, so make sure you watch the next video to see why.